Welcome to the Lock Zone with the Colorado Mortgage Team.
Ho, ho, ho. Merry Christmas and happy holidays. Welcome to the Lock Zone with Quentin Sistrunk, your mortgage engineer. Okay, today was a very important day. We got the final Fed announcement of the year, and they came out and they cut 25 basis points like everybody thought. However, they trimmed their forecast for future Fed cuts for 2025 and 2026. Now, we expected that they would do this, but the markets caught it a little bit offsides, and so you're seeing a little bit of a reaction. So let's go to the charts. All right, so the first chart I want to look at is the chart of the 10-year Treasury in real time. Now, I don't know if you guys are signed up for the Lock Zone where you get our emails and our texts, but if so, we sent out an alert right here when we broke 4.25 on December 11th and told you a lock alert, lock immediately. The market was going to be off to the races, and you can see that's exactly what we've done. But the Fed cut right here today. We had a jump up. We're now approaching 4.5 again. We're going to see if that holds. If that holds, we might see give back. We might see more positive pricing, and we'll show you some of the reasons that I think that that might be the case in some other charts. But let's just watch that level. This is our new target, 4.5. We're watching it very closely. If we break 4.5, you're going to get another lock alert from me. But if you're closing anytime in the month of December, you should be locked. You shouldn't be floating, and you should have locked on December 11th where we threw that alert at you. Okay, so now why do I think that we might be topping in yields where we're going to have a give back? Well, this is a chart of gold versus treasuries. Historically, gold and treasuries typically follow each other. They're both safe haven assets, and so people go into them for the same reasons. Recently, you can see gold has taken off where treasuries have fallen apart. When treasuries go down, rates go up. It's an inverse relationship. So as this is coming down, rates are going up. Meanwhile, gold's been taken off. Now it looks like gold's beginning to top out, and it looks like we're beginning to bottom out here on yields where you're seeing a series of higher lows, right? We've seen 1, 2, 3. And so I think there's a good chance that we're topping out on yields. Now we're in a low volume period right here at the end of the year. And so you get these exaggerated moves. And so we can still see some more upside. We just saw it today off the Fed move. So we could be pushing 4.5, up against that through the end of the year. That wouldn't be unusual. So what's our strategy? Our strategy with locking here is that if you're outside of 30 days, you're into the end of January, you're into February for your close date, I would be floating right now. I wouldn't be paying for an extended lock. We want to be floating to see if 4.5 holds. If we break 4.5, you want to lock immediately. We'll send out an alert. That's why you want to click the link in the description. Make sure you're part of the lock zone. But as long as 4.5 holds, you want to float this out. Wait till the new year comes around. Give a chance for yields to roll over. Now, if you're not a part of the lock zone, then you can sign up. There's a link in the description so that you can get our text and email alerts. If we break 4.5, you're going to get a lock alert from me because that means that we are headed closer to 5.0. So this is the commitment of traders report. So basically, this is large commercial and non-commercial institutions that are putting on trades, bets on where bonds are going to go up and down. And why does this matter? Because this is a huge market, and this is what moves markets. This is short-held positions down here at the bottom right of this chart. And you can see that there is a massive short position on bonds, meaning people are betting that bonds are going to go down, which means rates are going to go up. And we just saw that spike off of the Fed cut and the trimming of future guidance of rate cuts. Now it's time to ring the register. Over 50% of trades are short on bonds that they're going up. So as they ring the register, as things begin to change and these trades come off, there is your kindling, your catalyst for what can drive yields up and rates down. Because remember, it's an inverse relationship. All right, so now let's look at a 10-year Treasury chart that we've pulled back for 5 years. You can see we hit 5.0 back on 10/22/23. So if we break 4.5 on the 10-year Treasury, we're probably going to 4.7. We're probably going to grab 20 basis points. We're going to go there. You're going to have a lot of resistance between 4.7, 4.75. We get through that, and it's 5.0. We're going to retest 5.0. Now, I don't see that happening. I think that's an extreme case. Like I said, I think people are going to start to ring the register. Some of these short positions are going to shrink down. I think gold and yields are going to converge back towards the mean. Now, the Fed's forecasted a couple cuts for 2025. I think it looks closer to 3 to 4 once the data starts to play out. I think we're going to have a good year. I think we're going to have a good year in mortgage rates. I think we're going to have a good year in real estate. I think we're going to have a good year in the stock market. I think gold's going to flatline. I don't think it's going to fall apart. All right. Happy holidays from all of us here at the Lock Zone and the Colorado Mortgage Team. We hope you have a magical season, and we'll see you at the next episode.